Hi, I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree.
And I'm Jeff Weniger, head of equity strategy. And this is Minds on the Markets, where we go behind the scenes and beyond the trends to explore the forces impacting our markets.
Post-Fed world here for this edition of Minds on the Markets. We had the Fed meeting occur the other day, and here we are now from 3 rate cuts in the dot plot down to 1 in the markets, kind of trying to figure out what is that going to mean as we move into, believe it or not, Jeff, the second half of the year. But, I think another interesting topic, and it ties in with the labor market, which continues to show, a really resilient type of setting. Some could say maybe a solid setting so far this year, but what does it mean for the consumer? I think that's what there's a lot of questions on. And I don't mean it from a GDP standpoint, but let's look at it from its equity participation. What about consumer staples?
Well, and then that's one of the things is there's many of us sitting here kind of saying, okay, this will be when the labor market rolls over. Oh no, well, next month the labor market. No, next month the labor market will roll over. It has softened, but we continue to blow out, at least on these headline numbers. I mean, in the internals, you can see more part-time job creation at the expense of full-time, that type of thing. The unemployment rate at 4 by any measure is famously hot, but it has backed up from 3.4 a good 5-6 quarters ago at this point. But it's kind of just been this gentle deterioration. And we're looking at the internals of the stock market, and consumer staples is one of these sectors where you keep saying, okay, as soon as the jobs market rolls over or starts to materially weaken, that's when staples will start to finally click. But we continue to have to wait.
Now, why is that, Jeff? I mean, you think about it, right? I don't know. Maybe it's me coming from the bond market side of things. So set me straight on this. You would think a good labor market setting is good for the consumer. Why is this relationship between the labor markets and consumer staples maybe a little bit different than what, say, the normal type of investor would be thinking about?
Well, it's because usually if the consumer seems to be robust, or if there's job creation, maybe you want to be more in consumer discretionary. And the reality is that for the last 15 years, I mean, literally 15 years since the bottom of the bear market, staples hasn't been able to keep up because there's just been more excitement elsewhere. And we haven't really had a big cataclysm other than the 6-week bear market during COVID. And so this is a defensive sector. It's underperforming year to date, mostly because we haven't had this shock thus far. And if you go back 30, 35 years, there's only a few windows of time when consumer staples can outperform. You think of the 1990-91 recession, and that was a pretty good couple of years there. Staples clobbered the market from 90 to 92, which was a generally pretty positive tape because that bear market was just the summer of 90. Most of the alpha, when Staples has managed to generate alpha in the last, literally 20, 30, 40 years, was the dot-com comeuppance, because tech stocks lost 3/4 of their value. And sometimes forgotten, I think, in the 2000 to 2002 cycle, that recessionary job loss era, was that Staples was a sector that went up. People don't really realize that because about 2.5 years of pure carnage in the S&P, but staples were up in that period. And then, of course, the global financial crisis, where you had a downside catcher situation. It depends on which index you're looking at, but in the GFC, the S&P ultimately lost about 50 or 55% of its value, and staples were down about 20%. So it's one of these defensive sectors. It needs fear in the market, and frankly, with the S&P up around 5,300, there's just not a lot of fear, and so the sector can't get its act together.
So, final thought, give us some perspective. Everyone talks about the Magnificent Seven.
Yeah.
I hear that, once again, being the Bond guy, I just think of the couple of movies that came out with that title, but I know it means something else for you. So give us some perspective with this run-up that we've seen on the equity side. How have consumer staples done more recently?
And well, it's been one of these situations where most of the sectors are having a pretty good year. You saw utilities go ripping higher for a pretty strong window of time this spring, and it just kind of petered out of late. But that's one of the other defensives. And the Mag 7 is its own animal because there's this big question of how much the FTC will crack down on those. There's about 3 or 4 of those names are really in the crosshairs. There's been an activist type FTC for a good 2-3 years. A lot of M&A is really getting questioned by that entity. And so that's one of the big questions is, okay, if the Mag 7 loses some of its glory or loses some of its luster, becomes a laggard, what is it that gets you there? And is it a spooked type market, the type of market that usually gravitates towards the healthcares and staples and utilities of the world? We'll have to see if that ends up coming. But again, the thing that will catalyze it, if you look at the last 3 or 4 cycles, you have to have the labor market get weak. Otherwise, some overweight or long only position in staples is going to go kaput.
Got it. All right, Jeff. I think we're gonna end it there. Thanks for the comments. I thought it was is quite interesting, actually, from my vantage point. Thinking about it along the ways that you laid it out there. So this is Minds on the Markets, everybody. Sitting here on YouTube, and please go to our website, check it out. We've just started doing these videos over the last couple of months. Hopefully you like it, and tell your friends. Have a great rest of the day and great week or two until we speak again.